The motion be agreed to.
Mr. Speaker,
The Honourable David Parker.
well, we've got a bit of competition for this call.
Yes,
I was very happy to stand aside and. Mr. Speaker, the Labor Party is supporting the Insurance Prudential Supervision Amendment Bill. It is, as the Minister described, and is the sort of housekeeping legislation that normally finds support across the House. There are a couple of things that I will traverse. First is there are a couple of minor changes that were made by the Select Committee. The first, as the Minister has outlined, is just to extend from 3 to 4 months the period in which interim financial information must be prepared and given to the Reserve Bank, and this is now aligning with the Financial Reporting Bill, which is currently going through the Commerce Committee, or has been through the Commerce Committee. The second relates to provisional licences. It became apparent that if an institution couldn't get a final licence because, for example, it had become insolvent, that the Reserve Bank would have lost its oversight function because a provisional licence couldn't stay in force. That obviously isn't very sensible, and so the committee recommends that provisional licences can stay on foot to give the Reserve Bank some continuing powers in respect of those entities until such time as they either cancel a licence or if their problems can be fixed, they can move to a full licence. There's one other issue, Mr. Speaker, which is not directly affected by this bill, but I think it's good to put on record. There's a debate going on in New Zealand at the moment as to whether the period, whether the strength of insurance companies and their financial worth should be sufficient to meet a 1 in 500-year event or a 1 in 1,000-year event. And the reasoning that lies behind, is my understanding, the move towards requiring them to be strong enough to withstand the consequences of a 1 in 1,000-year event rather than a 1 in 500-year event are that the Alpine fault goes once every 800 years, roughly, and the big quake that could hit New Zealand or Wellington in that rare event ought to be able to be catered for by the insurance community without going broke and effectively leaving it to others, perhaps either putting the onus on to private individuals who would be left uninsured or leaving it to the government to pick up the bill. This is a very difficult decision because there are trade-offs to be made as to whether the additional level of security that would be obtained is, 1, necessary, 2, affordable, because if there are greater capital requirements required of insurance companies, then that cost will be passed on to consumers through the insurance bills that they pay. So the first problem could be that if insurance costs go up as a consequence of this higher degree of confidence that we would have that they could meet these very expensive but rarer events, it might be that it leads to lower levels of insurance because people can't afford their insurance bills. So that's one issue. The second issue, and this was raised with me recently by a senior member of the insurance industry, is that if the capital requirements become too high, it may be that some of the multinationals who are present in New Zealand cannot get the support from their parent companies to provide the additional level of capital that's required by the New Zealand regulator because they won't be able to get a decent rate of return on it from the insurance market in New Zealand. And as a consequence, some of those insurers may withdraw from the New Zealand market or reduce their presence or become more selective about the sorts of cover that they're willing to offer because their parent-owning bodies overseas are not willing to extend the additional capital to the New Zealand subsidiary to meet those requirements. The third problem with it, potential problem, is that if the capital barriers to entry for new entrants go even higher, we are likely to become even more dependent in New Zealand in an important aspect of our financial services sector, namely our insurance companies, on overseas-owned companies, and they will face less competition from New Zealand-owned entities. I think these are three very important concerns, and whilst I understand the concerns of the Reserve Bank to improve from a Prudential point of view the likelihood that insurance companies can meet large events, we have to be very careful that we properly take into account the three factors that I've mentioned: the cost of insurance, the likelihood that, or the possibility that some of the multinational insurers will not get the capital backing required from their parent companies to meet those commitments, and therefore might withdraw from the market, which would have both a lack of competition, reduced competition, and again could drive up costs and also increase risks, because we'd become more reliant as a country on a smaller number of insurance companies. And then the third issue is whether we're going to see ever greater capital flows or returns of profits from New Zealand insurance market to overseas companies, because it's less likely that we will have New Zealand participants in the insurance market. So that issue has been raised with me by more than one representative of the insurance industry, and I believed their comments to me to be unedited and not self-interested. They actually weren't talking in pursuit of their own interest. They were talking about what they thought was in New Zealand's interest, and I believed them to be straight in that regard. So that's an issue that we've got to grapple with, and it's a complex one, Mr. Speaker, and I hope that we get that one right. In New Zealand, Mr. Speaker, although this area of Reserve Bank policy finds in this bill the support of the Labour Party, it's fair to say that we have considerable concern with the effectiveness of overall Reserve Bank arrangements in New Zealand. We're not convinced that monetary policy is yet right. It was interesting when 3 years ago we pulled out of the cross-party accord on monetary policy that we were accused of heresy, and a couple of the things that we called for to be changed have quietly been changed since, namely the adoption of, albeit in a somewhat clumsy way, of the macro-prudential tools, and also a discussion paper that's now out from the Treasury, or some work that's being done by the Treasury, looking at whether the decision-making process in the Reserve Bank should be the governor, or whether it should be the board that takes decisions relating to monetary policy, which is another change that we called for. Strange how these things were heresy a couple of years ago, but when there's been true leadership shown by the Labour Party, even occasionally the National Party follows suit. Where they haven't, what they haven't addressed in respect to monetary policy is, of course, the fundamental problem under the Act, which is that primacy has to be given by the Reserve Bank to inflation targeting ahead of other important aspects of economic management that are impacted by monetary policy, including the exchange rate. Mr. Speaker, as a consequence, we have fewer jobs in New Zealand, and we have a larger current account deficit, which is probably New Zealand's largest economic vulnerability. Much larger cause of problems than the insurance matters to which we are referring here. That is not to diminish the importance of the Insurance Prudential Supervision Amendment Bill, which the Labour Party supports.
Call Paul Goldsmith.
Thank you, Mr. Speaker. My pleasure to speak on the Insurance Prudential Supervision Amendment Bill. And